Ladies and gentlemen, my name is Jess Fergali, and you're listening to Working Capital, the real estate podcast. I have a returning guest, Brian Beaulieu. Brian is the CEO and chief economist of ITR Economics. He is also a returning guest from episode number 67, if you want to go check that out. Brian, how you doing today?
I'm doing well, Jess. How are you doing?
I'm doing great. Always good when I get to talk real estate with an economist. So nothing's happened since we last spoke, episode 67. So I'm thinking about a year and probably just over a year ago.
Yeah, nothing's happened since then. You're absolutely right. Oh man,
Yeah,
what a long year it's been. I don't know. Life still isn't back to normal since the pandemic hit. We're going through all these COVID echoes. This is what I call them. I mean, the inflation is a COVID echo because it stems from the government's and Federal Reserve's response to the pandemic. And now we have higher interest rates as an echo because that's stemming from the inflation that stemmed from the pandemic. And those two factors are having other echoes, including through the real estate market. I mean, we're still years away from being back into normal economics, in my opinion, and that includes the current yield curve and the extremeness of the yield curve, which can lay directly at the feet of the Federal Reserve, and that isn't going to do any of us any good either. So we're still living with the economic after effects of COVID, even though we're running around without masks anymore. We're bearing the scars, the economic scars.
And how, if you were to grade the fiscal policy, let's focus on the U.S. For now. How would you grade that fiscal policy response and continued response to the economic environment that we're currently in?
I grade it as C. It's fairly average in that with each successive economic quote unquote crisis, the fiscal policy response has grown disproportionately large. At the point now where when we see a fly on the windshield, we don't even think about it. We just grab a sledgehammer to kill the thing. There's no measured response anymore, it seems. And it just occurred to me, it seems to be in direct response to the divisiveness of the two political extremes. They seem to want to outdo each other in terms of, bringing in favor and votes and getting reelected at ever extreme levels. It's very disturbing.
So do you see on the monetary side, so we're, since we last spoke even, we've gone up on interest rates a number of times, continued, if anybody had construction loans or anybody was doing any variable type of debt, they definitely felt it over the last year. Did you, playing Monday morning quarterback, your view of the interest rate increases, did they overdo it? Was it just enough, not enough?
Oh, they get an F. The Federal Reserve gets an F. They were too slow to start to push those interest rates up. And now they're going way too high. They've created this inverse yield curve. It's Federal Reserve 101. The Federal Reserve is supposed to be looking at the long gone, taking some clues from that. And Chairman Powell and this Federal Reserve, they seem to be off the reservation. I don't know if I can even say that anymore. You probably have to edit that out. They seem to be no longer playing by the playbook that we all have known through prior cycles. And they're by now, they should have been saying, not we're going to increase rates by a smaller amount. They should have said, we're stopping because disinflation is here. And let's see how far down it's going to come without us ruining the economy. I mean, they should have come to that realization 3 or 4 months ago, and they failed to. And hence, we're in this inverse yield curve situation, which is not pleasant. I just went through and looked at for all of our December client accounts, the data will be touching their company data. 43% of our clients in December will be able to tell them that they are not interest rate sensitive. The inverse yield curve is not going to be adversely impacting them. But for all the others, they're clearly at risk because of the interest rate trends that have been forced upon us, really.
So,
and it's getting back to your concern. It is, the unaffordability of the single family houses now it's not the fact that housing prices went up so much during COVID because the market's already correcting for that. We're seeing those markets in key metro areas coming down. It's what I call the Peloton effect. Everybody going out, everybody's in quotes. I got a Peloton because you were stuck at home. Demand was screwy relative to supply. Prices went up. Now the Peloton's sitting in the closet after being used for all of 6 or 8 weeks, something like that. Prices in those key metro areas are coming down, but the rates aren't going to come down enough to offset the damage that has been done. And the builders at the same time, at least the ones that I've been talking to, are saying, look, I don't need to be pulling all these permits. I'm not going to hold the land. I'm not going to pay those carrying costs. My backlog is good for 23, so I'll think about pulling those permits further on down the line when I'm back out there. I'm constantly telling people when they, not strangers, but when they ask me, this isn't 2006, 7, 8, 9 again, though, because the homeowners out there actually qualified for their mortgages this go round. Homeowner vacancy rates are very, very low, and the consumer is in really good shape financially speaking, despite what the headlines may be saying. When you look at loan delinquencies, whether it's auto or housing, you look at on the corporate side of the street, businesses are still in reasonably good financial shape. Very, very different scenario than what we saw in 2006, 2007 in particular. So we're not, the paradigm I think that we should be looking at is more like 2000, 2001 or 1990, 91. And Jess, I mean, you may have read about the early 1990s, but
Survived till 95. Well, yeah, I mean that's a great point. So interest rates have gone kind of crazy compared to the last 10 years. Inflation is where it's at, but for those that do remember '08 and prior to my time, 1991, you're saying that the paradigm we should be looking through is the early 90s or the .com era. Why is that? Why does that paradigm make more sense than say '08?
At least for the real estate market, it makes more sense because of the inventory levels, buyer qualifications. I even remember in 1987, we had another housing crisis in through that period. And again, it was people who were way overextended, and you could see it in their balance sheets, and we're not seeing that in consumers' balance sheets today. Real incomes are going up. That by real, I mean after adjusting for inflation, which is incredibly important because that means our incomes are still rising and will match these market levels eventually. It just takes some time to readjust the market. But what I've been doing is, and it's for housing, for our clients, for just about anything that I can trend, I actually look to see the upside deviation from the long-term trend. And that helps me identify the Peloton effect. And housing clearly experienced the Peloton effect. So we have to go through this. I think it's going to be 2 to 3 more quarters of lackluster single family market activity before it starts to turn around and we start that recovery process. Then we run the risk of that getting short-circuited, that recovery process getting short-circuited in 2024 because of the inverse yield curve. So it's the intermediate outlook, for me, that includes 2024, doesn't look all that great for single-family housing units. Now, multifamily, to me, looks fantastic because you're looking at an affordability problem for single-family homes, and we're still looking at low vacancy levels for those multifamily homes, and the affordability quotient is going to work there where it doesn't work on the single-family home. So they're both residential market, right? But one's going to be much more resilient to these economic circumstances than the other is. Mm-hmm. And since the last time we talked, Jess, I did this analysis. It was fascinating to me. Single-family new homes, those prices experience quite a bit of beta on the way up and on the way down. Whereas the multifamily is very resistant to decline in price. Those prices went down in 2008, the Great Recession, that through that period. But in other recessions, they just flatten out. They don't really go down, and they become a much better store of value. If you want, you'll strike it rich if you strike the single-family market correctly. But if you want to play the long game, then you're better off in the multifamily market. And I correlated multifamily home pricing to existing to stock market. It's oblivious to the stock market. I correlated it to the general business cycle, GDP or U.S. industrial production. It's not correlated to that either. In other words, it's a wonderfully safe place to be for the next 10 years with all this craziness going on around us.
So, Brian, you know that I'm a student of economics, but I only play a smart guy on TV here. So, if you could educate us on we see good job numbers. I see all the anecdata we look at. We see businesses hiring. We see that there isn't a credit crisis like there was in 08. But we still look around and there's this talk of recession in the next year, the next 2 years. What is the driver for the layperson of that outlook into the next year or two?
Well, the first driver is that's what the headlines are screaming at us day after day after day. So it becomes part of our emotional makeup when you hear that sort of thing. And because some sectors, like we've seen the housing market pricing come down, we know household furniture is doing poorly. We know that home exercise equipment is doing poorly. All those Peloton factors, it's not hard to spot them. 30% of the customers, our client data that I looked at for December, had some Peloton effect. So they're feeling this air underneath them after they're running so hard in 21 and 22. So that impacts the thinking also. But you have to separate the 30% from the other 70% that aren't feeling that. And that's what keeps it from being the Great Recession redux.
So if from the practical standpoint for investors or even homeowners that are getting into real estate or recently purchased real estate where interest rates are where they are, what is the conventional wisdom's suggestion or advice in terms of longer term fixed rates versus shorter term, refinance in a couple of years? Are you seeing a trend in one way or the other?
When it comes to those long-term rates, my preference would, and what I would personally do is go fixed either for 7 or 10 years, get a fixed rate. They may come down some, and I know the street is loading in some assumptions about interest rate decline. I wouldn't bet on that. We're not going to see inflation correct as much as we have in the past, and therefore we're not likely to see the interest rates back down as much as we have in the past. And while waiting, home prices 2-3 years from now could very well be up considerably from where they are today. So you'll pay about the same rate mortgage for a higher priced home. So if you like it, pull the trigger now.
So we're also seeing rental prices in most of the major markets that we're in go up quite substantially. And the idea of real estate investing for us has always been this idea where you can pass on some of that inflation to your customers or renters. Do you see a correlation between the valuation of where homes are now starting to get priced in, I guess, quotations properly, and the rate that we're able to increase rents? Because what I've noticed is that especially multifamily, most of the people in our market here in Toronto, and I was just in New York this week, they are very, very sensitive to dropping any valuation because they've seen their prices, at a certain high. So I feel like there's a bit of a lag there, but at the same time, we're seeing rental increases that we haven't been able to get in years over the last year or two. So what do you make of that, the interplay there between valuation and the recent ability to increase rent quite substantially?
Well, you're going to help me out here a little bit. Valuation of which asset, single family or multifamily?
Yeah, so in this case, I'm thinking more on the commercial end, but we can choose multifamily as that commercial asset.
Okay. Because commercial to me is a very broad bucket.
Yeah,
So,
yeah. I mean, the commercial multifamily, as in 5 units or greater, so
okay.
apartment buildings.
Yeah. Um, it becomes uh, um, a positive feedback loop in that um, the external single family competition is difficult to afford, which means you can raise rates. And because you can raise rates, and because of the historical tendency for those valuations to be sticky in that particular market, becomes even more valuable. But there is that lag, obviously, between the cause and the effect. Um, I think that's a trend that we are going to see go on in a positive way, from an investment standpoint, in a positive way through the rest of this decade and maybe a couple of years into the 2030s. So this is just the beginning of that ride from our perspective.
So in the business cycle, where do you see us in, are we headed towards the trough? Are we in it? Yeah.
We're not in it yet, not from a macroeconomic perspective. Um, you know, you're in Toronto, so the circumstances are somewhat different because the US dollar is so strong right now that it is distorting the economics between
Yeah.
north and south of that border. Um,
Yeah, I
because
did. I did a crazy thing last year. I I bought my first U.S. property pre-construction, so I got hit with the interest rate increases, and I got hit with the dollar. I was like, "What can happen in a year?" Turns out a lot.
yeah, um, sometimes you just get lucky. Sometimes you just get unlucky. That's the way it works.
Yeah,
But
it's I was at Danny Kahneman and Tversky where it's that loss aversion, right? I'll remember about this one, but 10 years ago when I hit it out of the park, I won't remember that. So you have to think it kind of evens out in the end. We're in it for the long haul in real estate.
oh yeah, you absolutely have to be. Which state did you buy in the States?
So I bought in Orlando a townhouse.
Oh,
Yeah. But what I still amazing or what was amazing to me was that the actual yield was a 9% yield. And like cap rates in Toronto at the time, even now they're starting to come up, but 3-4% was like your typical cap rate in Toronto. So
wow.
even with the interest rate increases, as a foreign national, the lowest I was going to be able to get was in the low fours. It turned out to be somewhere in the sevens. I don't even want to think about it now. But the, the good headline or the thing that was the silver lining, I guess I should say, was the fact that it still was going to coverage and cash flow, which most of our major markets and in U.S. major markets, finding cash flows is not the easiest thing to do in some of the
Oh yeah,
other. Yeah.
absolutely. We, thanks for telling me the specific market. I mean, you're not going to go wrong in that market. You play the long game. I know you do, and you're going to be smiling at and patting yourself on the back down the road. So.
So, Brian, for listeners that I don't know if they haven't listened to the previous episode, your background as an economist, what does this look like from kind of an economics 101 standpoint of how we go into the next phase of the business cycle, and then what are the clues or indicators that show that we're coming out of a cycle, and maybe even using a historical perspective to kind of outline it?
Well, the big glaring clue right now is that we've had an inverse yield curve in the States sustained for 2 consecutive months, and that's statistically significant. And that means we are definitely heading toward turbulent waters compared to what we've been going through over the last couple of years, with more downside pressures and more weaknesses. Fortunately, though, as I mentioned before, the consumer is not in bad shape. And as you mentioned, the job situation is still 10.6 million unfilled jobs in the United States. Um, so those argue well for this not turning into a significant or appreciably bad, difficult downturn. But we're going to be feeling that downside pressure into deep into 2024. How are we going to know when we're coming out on the other side of it? Our leading indicators will begin to go up, and they are not close to doing that right now. We'll also know because I expect the stock market is going to be leading the way out of this also. I'm not at all confident the market isn't going to show us some more downside before it finally reaches its low. We'll know that we're nearing the low because it's been at least 3 quarters since the Federal Reserve has stopped raising interest rates. That'll be a good sign. That's a rear view leading indicator, if you will. But we'll pick that up through corporate bond prices. When the bond prices start moving in the right direction, that'll be a good sign that we're coming out of the hole. There's some things though that can hurt more than they can help. China's still a mess. China's going backwards. Their current political regime is taking them back into the 80s in terms of the politics, and that isn't healthy. And they are the world's second largest economy now. The good thing for the US, not so much Canada, is that we do more trade with Europe now than we do with China. So we're not as tied to them. But for Canada, China is still very, very important, particularly from a raw material standpoint. And they're not looking very healthy right now. So there's that underlying weakness that has to be factored in. And then we have the Russian invasion of Ukraine and all of those ripple effects all occurring at a wrong time in terms of trying to come up with a positive outlook for the economy as a whole. It's difficult to contrive one. And that's when I tell my audiences, look, remember this serenity prayer, okay? You and I aren't going to change the interest rate environment. You and I aren't going to change these macroeconomic forces, but you and I can decide what assets we're going to invest in, where we're going to invest in them. We can control all the microeconomic variables. And if you do that well enough, then those macro things aren't going to hurt you in the long run. They're just going to, why did I do that in the short run? But in the long run, those macro variables swing around, and because you made the right micro variable calls, you're a very happy camper.
There you go. So manage the manageables.
Exactly.
Perfect.
And
well,
for goodness sake, stop reading the newspaper. This is why we invented sports, so you don't have to read the news.
That's exactly what I was going to say. Be mindful of the time here, but that was, this aspect of in economics where it's expected, expected inflation. A lot of this, does rely on what the sentiment is out there in the economy. So, in terms of where we go from here, I guess that's probably a good suggestion to, consume less news because the headlines are usually dire. But yeah,
I think there's a correlation between news consumption and drinking, and they're positively correlated. So.
Yeah, it's weird. You go to the gym and you see CNN on, and it's like, why is this on in the gym? Throw a ball game on or something.
Yeah, exactly.
Okay, well, Brian, you mentioned prior to the show that you have a speaking event coming up.
Alan and I are doing an ITR webinar on December 15th. It is on inflation, interest rates, and the US dollar. And if people go to our website, itreconomics.com, they can see it advertised there, if you will, and they can sign up to be part of the audience.
Perfect. And for those that want to reach out, is the website itreconomics.com? Okay, yep. We'll put a link in the show notes. Okay, Brian, well, I appreciate you coming back on the show. If anybody wants to connect with you, we'll put some notes put some links in the show notes. But thanks for being part of Working Capital. My pleasure, and I look forward to bumping into you on the road like we did not that long ago. So that was fun. Perfect. We'll talk soon.